Hey everybody. So in this video, I just want to kind of go over what depreciation is and some, I guess the three most popular methods for doing depreciation, for calculating and recording it. So first of all, I think the biggest misnomer is that depreciation has something to do with recording the loss in value on an asset over time. And that's not really what we're doing, okay? Really what depreciation is it's the process by which we allocate the cost of an asset to expense over its useful life. Recognize this, if I buy a building for $250,000, I can't just take an expense for $250,000 in that first moment when I buy it, then use the building and gain benefit from it for the next 30 years. And never have another expense. And so instead, what we want to do is take that $250,000 cost and then divide it up into the asset's useful life. And then each year, typically we do it once a year. Some do it more often, like in a monthly accounting period. But at the end of each accounting period, we're going to do an adjusting entry to recognize a portion of that cost as an expense. We actually learned about this when we did adjusting entries. So what we have to do is we have to figure out our acquisition cost, and then we'll allocate a portion of that acquisition cost and claim it as an expense on our income statement. Sometimes we talk about this as sort of recording the using up of that asset, or the using up of its cost at least. So here's the information we need to calculate the amount of depreciation we're going to recognize each financial period. We need to know the cost of the asset, the salvage value, and that means the amount we think the asset will still be worth at the end of its useful life. And then its useful life, how long we expect the asset to be useful to us, meaning how long we're going to gain benefit from it. So the three main methods of depreciation we'll talk about in this class are the straight line method, the units of production method, and the declining balance method. So we're going to do examples of each method using the same asset. So here you can see we have an asset that has a cost of $10,000 and a salvage value of $1,000, which gives us a depreciable cost of $9,000. Sometimes you'll hear that term. It just means the cost minus the salvage value equals the depreciable cost. We also know that the useful life of our asset is 5 years, and then apparently it's some type of inspection machine that inspects shoes. And so we also know that its useful life, it will be able to inspect 36,000 shoes. So there is our asset to use for all of our examples here. So with the straight line method, we always use this formula: our cost minus our salvage value divided by our useful life in periods. So in this case, it's asking us to figure out, let's see, how much we're going to depreciate in 1 year. It is something you have to pay attention to. Sometimes you'll have a problem where they bought the asset 3 months ago and now it's the end of the year and they want us to do the adjusting entry for depreciation for the year. So you would have to recognize we're only depreciating 3 months worth. So that's something that is easy to mess up and you need to pay attention to. But here's the basic formula: cost minus salvage value divided by the useful life in periods. So if we're doing years, we would say 10,000, that's our cost, minus our salvage value of 1,000 divided by 5 years, means we're going to depreciate that asset at $1,800 per year. So at the end of the year, depreciation entries always look the same. We debit depreciation expense and we credit the accumulated depreciation account that is linked to that asset, okay? And remember, accumulated depreciation is a special type of account called a contra asset account. It always gets linked together with a specific asset account, in this case, machinery, and it shows us the amount of that asset we have depreciated thus far in its life. All right, so the balance sheet, it'll look like this. It'll say machinery, $10,000 less accumulated depreciation. This looks like it's after 2 years. And so you'll see the the cost of the asset minus the accumulated depreciation, and the number it gives us is what's called the book value, which is just the cost less accumulated depreciation. And so you'll see with straight line depreciation, every year we'll depreciate $1,800 per year. That's what straight line means. They'll do the same amount each year. And the book value, since it's the cost minus the accumulated depreciation, will drop. So in the year we purchase it, the book value is $10,000, drops by $1,800 to $8,200 in 2019, and so forth down to the last year of its life where we still have $1,000 in book value, because that's what our salvage value is, the amount we think we'll be able to sell that asset for at the end of its useful life. This is what's called a depreciation schedule. You'll see the columns give you the year or the annual period, the depreciable cost, the depreciation rate, the depreciation expense, the accumulated depreciation, and the book value. And so you can see there in 2018, it had a book value of 10,000. To find the depreciation rate for straight line method, you just take the number of years you take 100%, divide that by the number of years in the asset's useful life, in this case 5. So that means we'll depreciate 20% of that cost per year. And then to find the depreciation expense, you just take the depreciable cost times the depreciation rate. And then the accumulated depreciation, you see that adds up or accumulates over time. And the book value is just the cost minus the accumulated depreciation. All right, so there's the straight line depreciation schedule. So the second type of depreciation is what's called the units of production method. Just another way. Recognize that depreciation, or allocating the cost of that asset across its useful life, is really just an estimate that accountants use to say, well, how much expense should I take for this? And so there's more than one way to estimate that. With straight line, we just say, well, we expect that we're going to use up and recognize as an expense the same amount of the cost of the asset each year across its life. With units of production, we say maybe for some assets, it's better to divide up the useful life by some other unit other than time. Like maybe a car that's 20 years old could still be really nice if it's only driven 1,000 miles a year. So we might say a car, instead of saying it has a 5-year useful life, we might say it has a 200,000 mile useful life. And so with units of production, it looks a lot like the straight line formula, but instead we're going to take the cost minus the salvage value and divide it by the total units of production. And then our depreciation expense will be the depreciation per unit that we calculated in step 1, multiplied by the number of units we did during the period. So in this case, if you remember, it told us that the unit, or that the machine equipment here had 36,000 shoes in its useful life. That's how many it could inspect. So to find our depreciation per unit, we take our cost minus our salvage value, divide that by the total units of production, and it come out to 0.25 or 25 cents. So what we're going to say is every time our machine inspects a shoe, we're going to depreciate or recognize 25 cents of the machine's cost as an expense. So in this first year, they used it for 7,000 inspections. So we're going to take 25 cents times 7,000, and we will depreciate $1,750 in that first year. So our depreciation schedule will look similar, except we'll still have our annual periods, but our second column will be the number of units that we actually use the asset to inspect. So each time we use it, that's a unit, okay? The depreciation per unit, and then the depreciation expense is just the number of units times the depreciation per unit. Our accumulated depreciation is the same in the sense that it's just our depreciation from the previous years plus any new depreciation. It keeps adding up or accumulating over time. And our book value is still the cost minus the accumulated depreciation. So there's our units of production depreciation schedule. All right. So now the last one is a little more complicated. It's called the declining balance method. This is used, I think, because we recognize with many assets that we use up more of their value early in their life, right? Kind of when you buy a car, if you drive that car off the lot, you've already used up a good chunk of its value. So you want to recognize more of that cost as an expense up front. And so we use what's called the declining balance method. And the one we're going to use for this example is what's called the double declining balance method. There are other forms of it that get used in real life, but for this course, we'll use double declining balance. So here are the steps to calculating our depreciation expense using the double declining balance method. So step one is we calculate our straight line rate. We do that by taking 100% and then dividing it by the asset's useful life. So 100% divided by 5 is 20%. There's our straight line depreciation rate. And we saw that when we did the straight line method. Second, we find our double declining balance rate by taking double or 2 times the straight line rate. So in this case, 2 times 20% is 40%. And then to find our depreciation expense, we're going to take our double declining balance rate times the book value at the beginning of the period. So in this case, since the book value when we first purchased the book or the asset was $10,000, that would take 40% times $10,000, and that would give us our depreciation expense for that first year of the asset's life. So here's our schedule. You can see in the first year we had $10,000. And so 2019, our beginning of period book value was 10,000 times our depreciation rate of 40%. Gives us depreciation expense of 40,000. Our accumulated depreciation, we had 0 the year before because it was a new asset, is now 4,000. So now our book value is our cost minus our accumulated depreciation, or $6,000. That 6,000 ending value for 2019 will carry forward to be the beginning value for 2020. Again, we multiply it by that 40% rate, which gives us a depreciation expense of 2,400. We add previous year's depreciation plus the new depreciation expense to give us an accumulated depreciation. And then our book value is our cost minus our accumulated depreciation, or 3,600. That gets carried forward to the next year, multiplied by 40%, gives us depreciation expense. Add that to the previous year's accumulated depreciation to get new year's accumulated depreciation. And the cost minus that gives us the book value. Repeat that again until the last year when the 40% thing won't work out anymore. And then all we're going to do is we're going to say, well, at the beginning of the year, we had a book value of 6. The asset has a salvage value of $1,000. So we're going to take as a depreciation expense whatever amount needed to be left over with that book value of 1,000. So if I had a beginning book value of $1,296, I will depreciate $296 and be left with a book value of 1,000. So that's the double declining balance method. Like I said, a little more complicated, but it's another one that gets used often. Most companies, more than half, use straight line just because it's sort of approved, and the IRS gives a schedule of the useful life of assets, and so you don't get a lot of arguments from the IRS when you use their schedule. All right, so just a little comparison. You can see sort of the accumulated depreciation, or the amount of depreciation per year by each method. With straight line, you see it's the same amount each year. Units of production, it varies depending on how many units we use. And then double declining declines. It starts at 4,000 and declines down to 9,000. Here's what I was kind of mentioning a minute ago. Straight line depreciation is used by about 85% of people who do this. Units of production by about 5%. This method's about 4%. So really, in real life, we could probably teach you straight line, and that would do you for most things, unless you were going to become a fixed asset accountant, and then you would learn more. But we just want to introduce you to these 3. I hope this was useful in explaining them, and I know it was a little long, and I'm sorry, but it was a lot of information to cover. I hope you have a great day.